All right, hello, and
This
welcome to
meeting
yet
is
another
being
Value
recorded.
Podcast. I'm your host, Andrew Walker, and with me today, I'm happy to have Tim Weber, my friend, second time on the podcast. Tim is a private investor. Tim, how's it going?
Hey, Andrew, thanks for having me. The real reason I'm on today is because I'm just trying to catch up to Jeremy Raper. And so I really appreciate it. I know I have a lot of work to do, but you never know. I could get there someday.
Yeah, I think Jeremy's at 6 or 7, and this is 2 for you. So you've got a lot of work to catch up if you want to catch up to him. But hey, let me start this podcast.
That's okay. I'm the tortoise and he's the hare.
Let me start this podcast the way I do every podcast. First, a disclaimer to remind everyone, nothing on this podcast is investing advice. I'll use the same disclaimer we used for Tim's first podcast. That disclaimer is particularly true today. We're going to be talking about a heavily leveraged microcap oil and gas stock and some heavily leveraged commodity names later in the podcast. So everyone should remember these are much higher risk names than normal. Please do your own work. Consult a financial advisor, not financial advice. Second quick disclaimer. Tim and I had a little bit of technical difficulties. I think he's on a slight lag. So if you're watching on YouTube or you notice a slight pause, it's just because of that, but I don't think it's going to cause any issues today. And third pitch for you, people can go listen to the first podcast we did, but you're a great guy, a super sharp investor. AMPY has been just an absolute killer. You nailed that thesis in the fog of war. When I go back and listen to all the stuff we talked about then, I'm always like, oh man, we really nailed this. Why weren't we, 5,000 times bigger when the stock was trading at 3, because right now it's tapping at the door of $6 per share. But this was great. The double dogs, which we're going to talk about, has been fantastic. But look, I'm just really excited to talk podcast. So all that out the way, today we're going to talk double dogs and an update on AMPY. I think it makes the most sense to start with the update on AMPY. So I'll turn it over to you. Since our last podcast, which was in the fog of war right after the oil spill, what's been going on with AMPY?
Yeah, Andrew, I think so. The incident was October 1st, and I think we did it within 1 week of the incident. So we were really just trying to take any information we could get our hands on and just frame the incident. And so there's been a lot that has transpired since then. So I'm going to try and give you what I feel is the most important. But if I miss anything, just come right back to it. So look, I've written about this on my Substack, but really, I tried to frame the incident, whether it was the size of the incident, the insurance coverage, comparing it to precedent incidents in the past. And I just tried to frame it, when we were in the fog of war and just say, okay, is this going to kill the company? It was that bad at first, right? You couldn't quantify the gross liability. You were just starting to understand what insurance might look like. The size of the incident was still a little bit in question. And for sure, the culpability of the incident was a total unknown. A lot of that has changed. So I'm just going to go through a few of the things that have happened since the incident. So first, December 15th, federal grand jury brings one misdemeanor charge against AMPY for negligent discharge of oil, which to me was a huge win. We did a lot of comparing to the Plains All American incident.
I believe
in that case, there were
when they put out the press release or whatever that said one misdemeanor, I was like, oh, my first thought was, oh no, I was hoping they'd get away. And Tim was texting me, LFG to the moon.
I don't remember that, but I'm sure I did it.
It wasn't quite that, but it was pretty bullish.
So in that Plains All American incident, there were 46 charges brought, of which 4 were felonies, right? So just as a first pass, and there are some differences. For example, a lot of those charges were brought by the state of California, whereas this was a federal grand jury. But look, it gives you a good sense of kind of the differences in the incidents here, and we'll get to why these incidents were so different when we talk about the lawsuit, which AMPY just filed a few weeks ago. So 46 charges versus 1. That was your first real. Look, we had a lot. There were a lot of speculation that things were going to work out here and that this incident could be contained and that there would be great insurance coverage and that sort of thing. But that was one of the first things in print where you started to kind of have a sigh of relief. So recently, March 2nd, Amplified filed a lawsuit against 3 parties: MSC, which was the owner of the Dannett vessel in question, that likely drug its anchor on their pipeline, Costco, which is the owner of the Beijing vessel, and then also Marine Exchange, which you actually mentioned in your podcast, which is essentially the air traffic controller in the region. All of these parties in the complaint, had knowledge of the incident and did not notify Amplify, all three parties. So they filed this lawsuit. You can go and find it if you're super interested in reading. It's actually pretty interesting and entertaining. Some of the details in the lawsuit made me very bullish. So the P&I clubs for both MSC and Costco posted what in the maritime industry is known as a letter of undertaking. So this is when your P&I club posts on your behalf, basically a letter of credit, stating that in exchange for you, the aggrieved party, in this case Amplify, not arresting the vessels, which would be a huge problem if you think about how much money container shipping is making on a trip by trip basis right now. So in exchange for AMPY not arresting the vessel, the P&I club for MSC posted, and it was quantified, a $97.5 million letter of undertaking, which essentially says, if we are found liable for these damages and your claim was indeed, real, here's a letter of undertaking for up to $97.5 million. Costco posted a letter of undertaking as well. Sorry, Costco's P&I club also posted a similar letter of undertaking, but it was not quantified in the lawsuit for what, I'm not sure exactly why. But if we assume that it's approximately the same value as the MSC letter of undertaking, we're talking about nearly $200 million of letters that have been posted to Amplify, which is well in excess of what Amplify in its recent 10K estimates the total value of the incident. Now, of course, the total value of the incident is almost a moot point.
Am I remembering correctly? The estimate was 99 million. I think that's right, or was it?
That's right.
99 million. Okay,
That's
just to
right.
give readers, so it's
Exactly.
2x coverage
here.
here.
Right, but again, the 99 is somewhat a moot point to the stock itself, just because insurance coverage, which I'll talk about next, has come in so favorable in print. So basically, you've got these two letters of undertaking. You read this suit, and it feels like Amplify has an incredibly strong case against both ship owners, as well as the, as I call them, the air traffic control. Their name is Marine Exchange. My guess is that what happens is there's some sort of reasonable settlement here. However, I would say there is that probability that if this gets litigated, Amplify is, of course, they're suing for both the damages, which is more of a matter for their insurance company, frankly, but it's damage and reputation, right? And so there is this, and it's funny because you asked me this question on the first podcast, and I laughed when you asked it. You said, "Hey Tim, is there any chance if this anchor scenario is true, is there any chance that there was zero net liability or even positive?" And I sort of laughed, right? Now it seems like that is actually an option on the table. So that's kind of right. When my guess is that, we have a really good estimate of what the incident is going to cost, and the insurance coverage is extremely high. I mean, we're talking 90% or more. And even the leakage will be, essentially what Amplify is asking for in the settlement, I would guess.
Yep.
But again, if you litigate and you get to the point of reputational damage, that's where you could be in this zone of even positivity. My guess is that the way that it plays out is that there's some sort of settlement which takes care of all the leakage, the deductibles, the things that just for whatever reason the insurance did not cover, plus Amplify's loss of production income insurance. You kind of re-sign that insurance each year, and they had basically locked their loss of production income at a really low oil price in the end of 2020.
Yep.
So you could argue that, when they lock loss of production in the high 40s, yet oil, goes $30, $40 higher in the next year, my guess is that that would be something on the table if we're sitting around the table trying to come up with a settlement. So, you know, we're talking, it seems to me to be getting more clear each day that this is a zero net liability issue. Now, of course, the next big question is, okay, but when will the pipeline operate again? And before I go there, there's, you know, this loss of production income insurance will cover 18 months. And so we are not even 6 months post-incident right now. And the time to fix the pipeline was measured in weeks, not months. It's actually a very straightforward fix.
So let me pause you there, because I think we're going to start talking about beta coming back online and everything in a second, which is kind of upside case at this point, right? But I just want to pause there. When we talked last, you know, I think it was a popular podcast. Listeners should go back and listen to it if they want to. But when we talked last, we were worried that, you know, AMPY was going to be on the hook. We were trying to size the liability. We didn't know because of fog of war. At this point, we do know the liability, right? The max liability is kind of 100 million. Maybe beta never restarts. Probably does. I mean, we're going to talk about that in a second, but we can size the liability. So we know the max liability is 100 million, and most of that would get covered by insurance. And our hope here is that, you know, insurance will reclaw a lot of that from the shipping company. Whatever insurance doesn't cover, AMPY will reclaw it from the shipping company in the suit. And maybe you laughed at me when I mentioned it, but now it doesn't seem so silly. Maybe we get a little reputational damages and AMPY actually makes money off that. But was that a good summary of kind of where we are with the legal liabilities, the cleanup and everything at that point?
Yeah, I think that's very fair. I was just going to mention that, you know, in the interim, since we did the first podcast, there's been a 10Q and a 10K filed. The first 10Q gave you the big glimmer of hope that insurance coverage was looking great. And the second report and the 10K gave you, you know, you never used the word certainty, but, you know, gave you a lot of confidence that the insurance coverage was more than sufficient.
Perfect. So that brings us today. As we talk, AMPY stock is, you know, it is March. Is it March 16th? It's St. Patrick's Day. March 17th, St. Patrick's Day.
How could you say that on St. Patty's Day?
I know. And look, I'm wearing white. Somebody's probably going to have to pinch me, but March 17th, AMPY stock is around $5.70 per share. And I mentioned that because I want to talk about, you know, why it's right here, right? Because people can go look at AMPY's investor deck, and they put out, hey, here's how much free cash flow we think we're gonna generate over the next couple of years. Hey, here's our PV10 at the end of year 2021 strip, and here's our PV10 at current strip, which, by the way, current strip is a lot higher than end of year 2021. And they say, hey, we think beta is going to restart in the next couple of months, and we build some of that into our model. And I don't think the market really believes that. So I want to talk through all of those things and why, you know, kind of AMPY is where it is right now.
Yeah. So, and it's funny because Amplify was at almost exactly the same stock price the day before the incident. So if I mess up my 575s, it's only because, you know, the stock was exactly there before the incident. So the day before the incident, let's rewind. So when I wrote this up, and I actually wrote it up a few weeks before the incident. So I mean, I'm sure the oil and gas moved a little bit, but probably not much. But I was essentially saying, okay, here's what I know. And this is assuming every asset is operating, right? And I said, in 2023, because they have some below market hedges in 21 and 22. But I said, if I look out to 2023, and I simply just put 3 to 4 times EBITDA on what I expect them to do at current strip, including all the hedges, because there's still a little bit of hedging in 23. I said, I think this stock can be worth $10 to $13 per share. At that time, the oil 23 strip was $62, gas was $3.50, and NGLs were around, I think I had $25 in my model if I mark these to market now, first of all, marking to market the 23 strip right now, my EBITDA in that prior scenario was 123 million on all assets. Again, this assumes beta's operating. It is now 212 million. Now look, there's going to be $10 million of restart costs, I'm sure, for beta, but just put that aside for a moment.
Which,
so again, EBITDA has gone
$10 million, which probably gets covered by insurance or the ships in the lawsuit, right? I
Probably
would
the
guess.
settlement. I would say more probably more the settlement you would go for that than insurance. But you know, let's see. So again, EBITDA marking to market has gone from 123 to 210. So that's 90 million increase in EBITDA on a company that has a market cap today of 220 million. The new range at 3 to 4 times EBITDA, rather than that $10 to $13, is 19 to 23. So you could say, okay, Tim, the stock was at 575. Who cares? It was at a huge discount, or made up 3 times EBITDA multiple in 23, right? To which I would say, sure, it was at a 40% discount, you know, to the 3 times EBITDA number in 23. That same 40% discount is now $11. And to me, what closes the gap to that $11 are 2 things. And it's going to preview what we're going to talk about next. What could close that gap is, of course, getting your permits, which AMPY needs in order to do the you know, let's call it 2 to 6 week fix that will be required to get data operating again. And the other one is actually crystallizing some of the value through a sale, which is a whole different topic that we can kind of move to next. But again, the equivalent of Amplify being at 575 when they're 3 times EBITDA, which is by the way, that 3 to 4 times EBITDA is a somewhat decent approximation for what they say their PV10 is. The equivalent today is an $11 stock on a company that's trading at 580 today. So to me, you've got this really big upside catalyst that will start to be crystallized, I think, when you get your permits to do your work on beta, and then if you sell an asset.
Yep.
Which leads me to my next point.
Go ahead.
Which is that as Amplify, you know, reported and, you know, started doing investor presentations again and did a conference call again because they had skipped last quarter just as they were in the fog of war. One of, to me, the most important disclosure possibly in that release is that they're selling their non-operated Eagle Ford asset. Now, this is the smallest of 5 assets. It only has a $50 million PV10 compared to a PV10 for the whole company that's approaching $1 billion. So it's a relatively small asset in the grand scheme of things. But symbolically, it's and by the way, you'll use the proceeds to pay down debt. They have a reserve-based lending facility, which is too large and which just introduces kind of, I would argue, stakeholder conflict, shareholders versus banks, which will be a good thing to wind down over time. But so Amplify is actively marketing this non-operated asset, and it should be a relatively straightforward sale, right? I mean, a financial buyer could look at it, or the majority operator could look at it, which in this case is Murphy. And this is a big positive, right? Because any stock can be at a huge discount to fair value. It does not matter if there's not a path to close, if there's not a path that closes this current trading price versus what you have in your model or versus what Amplify has in their deck. It's irrelevant, right? But if they go and trade an asset at PV11, let's say, then that implies that the whole company is worth $20, right? And, I would argue if you pick apart each one of their assets, you can make a really strong case for why each one could trade at PV10 right now.
Yep.
And again, that PV10 has a 2 handle on it right now. And 2.20. And this is a $5.80 stock, right? So to me, again, there's a little bit of, this is somewhat symbolic. This is somewhat about just reducing the size of the RBL. But to me, what's really important is that if this asset trades at, PV10 to PV12, this really does, it's a lot harder to make that argument that who cares? It's just a theoretical value in your spreadsheet.
Let me give you the most, the pushback on that, right? So I hear you, I'm bull, I'm with you here, but Eagle Ford, as you said, is a non-operated asset. And I believe Eagle Ford's their only non-operated asset, right? So I think you and I, as generalists, generalists generally get their face ripped off in oil and gas. I think our first thought was Eagle Ford is their worst asset because it's a non-operated asset. And I believe we've heard a little bit of scuttle blurb since the thing came out that we are actually wrong, right? They're like, no, Eagleford's probably your best asset on a PV10 because anyone can buy it. It's really simple, right? There's lots of, you can have financial buyers. They can just come in and say, oh, cool, we'll just cash those checks. You can have the majority producer buy it. You can have somebody who's just looking for a little asset diversification and to get kind of into southern Texas if they don't have oil and gas exposure there, right? So it's small. It's probably really easy to just flip it to a variety of buyers. Whereas everything else they have, I believe, is operated by them. So buyers have to do a lot more due diligence. There are fewer buyers. They have to make a lot more assumptions on that. There's kind of no one, in this case, Murphy, who's the majority owner on Eagleford, is kind of backstopping a lot of the assumptions there. So I think my first pushback would be, if I saw a press release tomorrow that said Eagleford sold for about PV10, I would be like, oh yes, stock to the moon. But some people might say, oh, well, everything else, you can't value everything else at PV10 because it's so different. How would you respond to that pushback?
So I would just say, each asset is going to have its own peculiarities. The fact that it's not operated means definitionally there's no paying up for any incremental development opportunities or any idiosyncratic, benefits to that asset. So let me just give you two examples. The Rangeley assets, so the Colorado assets,
yep.
They have this angle where, it's enhanced oil recovery using CO2, ESG positive, 45Q tax credits, which AMPY is not currently receiving. I believe the way that it works is that Exxon receives the credits right now. But what if somebody had a strategy, to use the CO2 and to get the 45Q credits, let's say, as one example. The East Texas assets do have incremental drilling opportunities, right? And so there is still to spend CapEx there at, obviously with today's natural gas strip, incredibly high IRRs. So I would say each asset has its own peculiarities, which certain buyers might see as a positive. So look, we obviously listed what the positive on Eagleford is. It's just a financial transaction, right? I mean, if I'm Murphy, it's, hey, $50 million on my revolver costs me $1 million a year of interest expense, right? Pretty straightforward transaction.
This doesn't apply to Amplify in particular, but I've been really into, or I've spent a lot of time looking at recently all the controlled MLPs from the giant companies. So a great one right now is Shell is talking about buying Shellix, which I've talked about. I know Matt Turk, who's been on the podcast, has talked about. They're looking to take them out, right? They filed a thing that said, hey, we own 70% of you, we'll flip you. And all the MLPs have been doing this because look, the MLPs yield to the equity 10%, right? They own these great pipelines, they yield 10%. And I think Shell and all these guys are looking and saying, well, with oil prices where they are, we need to start drilling some more. We need to control our infrastructure. And by the way, that equity yields 10%. We can go buy it and we can issue debt at 40-year debt at 3% to buy it. Like it's super accretive for us to go buy it anyway. So and exactly what you're saying with Murphy, they can look and say, oh, well, Amplify's cost of capital right now is probably 15% implied by the market. Our cost of capital is 4%. We can split the difference at 10% and everybody's going to be super happy with that.
Right. And to me, there's a lot of financial buyers that could actually, if you're a financial buyer, there's no reason that you wouldn't look at the same opportunity and say, oh, with no sweat off my back and no work, I can make this sort of IRR, right?
Exactly.
Which is also meaningful because you're not operating the asset. So I do think that one, it could be interesting. And again, I mean, I don't think the market's ready for this company selling an asset or two at PV10 for sure. Otherwise, the stock would not be here.
I want to talk beta, but you just said the stock would not be here. So let's talk a couple other pushbacks. I think the other pushback I get is, Tim, Andrew, you guys are generalists. Y'all are interested in Amplify because it trades at this huge discount to PV10. And now there's these really sexy catalysts with beta coming back online or winning a lawsuit or selling Eagleford at close to PV10. But, well, you were here before the spill, but a lot of people would say, look, before the spill, PV10 was $12 per share and the stock traded at $5. Today, PV10 is probably 20 and the stock trades at almost 6, but the PV10, there's beta risk. There's all sorts of other concerns. There's probably some concern that, the the trend path for oil and gas prices is probably lower, not higher, if you assume geopolitical tensions cool down just a little bit. There's probably a little bit geopolitical premium. Not to say it couldn't go higher, but there's probably a little geopolitical premium in there. I don't know what I'm saying on that, but I think a lot of people would say, hey, you're just interested in this because of these situations, but the best oil and gas investors have looked at this, and for years they've said, these are awful assets. We don't want to have them. Like it should trade for a huge discount to PV10. And the current share price kind of implies the same discount to PV10 as it did before beta. So how would you respond to that pushback?
I mean, I think the best oil and gas investors can't really invest in a $150 million market cap special situation. So it's almost a moot point.
They've all gotten so rich over the past 18 months that this is too small for them.
I mean, you could make a similar argument for, the small cap Canadian E&Ps make just as little sense in terms of they've got shallow decline curves. They're trading at crazy, call it free cash flow EV yields. And those don't make a lot of sense either, right? And a lot of incredibly smart oil and gas folks are making great money on, Canadian small caps. I would argue that there's a little bit of kind of the same energy here. Look, on the beta California risk specifically, you can't rule out that California won't try to intervene here, of course. The way that I'm framing it is, look, I'm sure they could figure out some way to file an injunction. And I'm sure if they do this, a federal judge would have to overturn that. By the way, I have a lot of confidence that it would be overturned because jurisdictionally, this happened in federal waters.
Can I pause you for 1 second, Tim?
Yeah, go ahead.
I think you jumped ahead to where I was going next. You knew where I was going, but the beta California risk is a lot of people are concerned. Beta, as Tim was saying, is in federal waters, but a lot of people have been concerned that California, because beta spilled off the coast of California will somehow try to stop beta, the asset that Amplify owns that caused this oil spill. They'll try to stop beta from restarting, even though the jurisdiction should be with federals because this is a federal water. So please continue. I just wanted to give that background.
Oh yeah, no, that's fair. So look, I think I can't rule out the California risk here, and it's obviously not the most friendly jurisdiction in the world. Now, one could argue that that's probably going to be changing a lot right now. I would argue that oil and gas production, is a few more geopolitical incidents away from being a patriotic positive, which is a total sentiment shift from where
one thing I've been thinking about is I know a lot of people, especially institutional firms, who would not touch anything defense or guns and ammo related. And all of a sudden, a month ago, here we are today after Russia invaded Ukraine, the EU just made guns and defense stocks, investing, whatever, they made them ESG friendly. And I have been thinking, like, things that were politically unacceptable, like as times change, oil and gas in 6 months, it could be ESG friendly to say, hey, in the short term, we need to do this. And, I'm sure on long term, like we still need to go green and everything, but in the short term, these could be ESG friendly moves.
Yeah. And look, and so the way that I'm framing it is you just compare, you compare what some other spills have looked like versus what this one looks like. And, just given what's going on with oil prices right now and how much of a hot button political issue this has become, are you really going to shoot your bullet here if you're California on a lawsuit that, by the way, has an enormous uphill battle? So look, but could an injunction be filed? Of course. Will the stock go down 10, 15% that day? Of course, right? All that my base case is that what that will do is simply just pipeline out to get beta operating again. I mean, look, all of this math we've been doing is on 23 anyways, right? So it would push your time frame out. They have loss of production income insurance for 18 months, and we're only 6 months into the incident right now. We're only 6 months post-incident right now. And so, but you can't rule it out, of course. But again, if this was a state really trying to fire its bullets, one misdemeanor is what they came up with. And by the way, any spotlight on this whole issue, really highlights a lot of malfeasance on the traffic that was allowed to congregate outside of the port of Long Beach. And so this is not so straightforward. It's a losing political issue. There's no question about it. Anything restraining American oil production right now it's just not the moment. So look, that's me playing political analyst, which you should, that in a quarter will get you
It'll get you nothing these days.
Arcade, but yeah. So anyway, those are my thoughts.
I think we've covered most of the stuff I wanted to talk about Amplify here. I mean, look, it's funny. It's an under $400 million. It's about a $400 million EV company, but there's so many different things, assets, angles to talk about. Are there any angles you wanted to, I mean, I think both of us are agreed. It trades at a huge discount to PV10. I think both of us think Beta's coming online. Even if it doesn't, I think the stock works pretty well from here, to be honest, just given that big discount and the free cash flow going through. But anything else you want to talk about on Amplify before we maybe quickly hit the double dogs?
Just two things. Number one, it's just always important to step back, and what this was before the incident and what it is today has not changed. This is the most leveraged US-based expression of high oil prices. There's operational leverage because they're higher cost oil, for example. There's financial leverage because they have debt, and then there's a tremendous potential for valuation expansion because of where they trade. The three of those, synergistically interacting, make this the best way to express a higher oil and gas deck. And that's just the math generally. But there's a little bit of qualitative judgment within that statement, but largely that's just the math. So that's one point. And then the other point, I would just say this management team has handled this incredibly well. They've been level-headed. They are talking to shareholders. They're taking shareholder input. I would argue that shareholder input is part of the reason why Eagle Ford is being marketed right now. And look, shareholders don't love having this major other stakeholder in the RBL, which might not always act in the best interest of stockholders. And so I would argue that management are doing the right thing in terms of, look, and they're getting a lot of feedback from a lot of different stakeholders right now, but they're not blocking out shareholders in the way that some companies do when they kind of go into hiding in the middle of a crisis. I would argue that the CEO and CFO have handled this really well from a shareholder perspective, which is what obviously my lens is.
Perfect. Yeah, I think the only other thing I'll just briefly mention, I know both you and I, well, you're the one who pointed it out, but I had been thinking, we were worried because this is a company that hedges a lot. We were worried about the beta hedges because, they had been put on in 2021 and beta isn't exactly producing now. We've been worried about that, or we've been worried about what I'll call the Peabody risk, where your hedges go so deep out of the money, you have to post collateral and you have to raise equity to post that collateral, even though you're going to produce that stuff, right? And both of those are off the table, right? The company wisely took off all of the beta hedges when beta shut down, which saved them, I think, like $20 to $30 million. So that was great. And now
at $66.
Yeah. And now if beta comes online, they'll be minting money off beta. That's completely unhedged. And then I looked through their 10K and they also confirmed on the earnings call. I don't believe that not that they confirmed it, but you can see because they haven't had to, they don't have to post collateral on their hedges as well. So on both those cases, I think those are two tail risks that have been removed or we can feel reasonably good about. Let's turn to the double dogs. Tim is the one who introduced the double dogs. I think both of us were kind of thinking along the same lines because my 2022 prediction said deep value stocks outperform. I cited a couple cyclicals. Tim went even harder. He found 10 or 15 cyclicals across the board that traded super cheaply, but I shouldn't be talking. I should turn it over to the founder of the double dogs. Tim, can you explain the double dogs, why you came up with it, how it's performed, and we can talk about a couple of names?
Yeah, for sure. So all throughout last year, I would look at new names and hear different pitches. And I kept coming back to this question that I was asking myself, but also that I would frequently hear from others for example, I was doing a lot of work on Arch. And the question was always, wait a second, if your numbers are even in the right ballpark, in the right stadium, how can this trade exist? It makes no sense. And so I was doing all this soul searching on that question, and a lot of folks were talking about it and posting about it, but with their own language, you know. And I'm running everything down. So in the case of Arch, it's misplaced ESG aggression. Is it because macro is just going to implode and I just don't know about it? Maybe it's the spotted past of, you know, coal management teams. But what I really started to realize is that there was no sense in running this down from an idiosyncratic perspective, you know, with coal, let's say, because the same setup existed in US Steel. And then the same setup existed in the shipping names, and the same setup existed in the lumber names and some copper names. And what I finally realized, and why I wanted to write a post about it, is that the common thread that runs through all of these setups was sort of this historically accurate market maxim that you never pay a low multiple for a cyclical. It's been a great market maxim. It's worked well. It saved you a lot of money, right? It's sound logic most of the time. But as we're learning with the last couple of years, most of the time keeps getting run over, right? Your things that used to work most of the time are no longer holding when we've just had the biggest economic disruption of the last century, you know, which was the biggest economic disruption followed by the most impressive, you know, synchronized global government response to a market disruption of the last century as well.
Can I,
Go ahead, Andrew.
Yeah, can I just add, I'll just add a tangible example. You mentioned United Steel. I did a post at the beginning of the year. United Steel was 20 or 21. And I said, look, this is a company, tangible book value is 28. It's trading for like 1 or 2 times EBITDA, 2 times unlevered free cash flow, like everything you're saying. I was like, steel at the time had come down from the peaks of kind of like summer 2021, but steel was still way above mid-cycle levels. And I was like, look, this company is saying we're going to print money, print EBITDA, we're buying back shares like crazy. We don't get it. And I posted that and everyone said exactly what you said. The time to buy cyclicals is not when the multiple is low, because that's the peak. The time is when it's high. And I was like, I get that, but it's low because they've been minting money for 9 months. It's not going to fall off a cliff overnight, and they're buying back shares like crazy. And by the way, it's trading below tangible book value. And, my only wish is I'd leaned into it harder, because the stock's gone from 24 to 35 right now, and I sold it at around tangible book. But I do want to ask you one question. So the strategies worked great. I want to ask you why no one believed in these multiples would be my first question. And then my second question would be, all of these have really taken off since Russia invaded Ukraine, and the markets for everything commodity went parabolic. And we can talk about why they went parabolic. But I want to ask, do you think these were going to work if Russia didn't invade Ukraine? Because that's what got US Steel working. That's what got a lot of these working.
Oh, for sure. Yeah. So I think that the average, I put 12 names into this index. By the way, it could have been 20. It was funny when I first posted this thread asking for input on names, folks were getting really emotional about which ones were in or out. And I just said, look, the whole point is just to tell a story anyways, right? It's not that big of a deal which names are in or out. So yeah, I mean, look, the average stock was up, I think 20% pre-Russia, and now it's a little over 40%. So yes, I think it was working. Look, it was a trade that was already working before I wrote the article. I was looking for terminology to explain it because it was just such a unique point in time, and there were so many different folks on, talking about this trade, but everybody had their own language. So I was just trying to create, a kind of a shortcut to, hey, what are we all talking about? Oh, we're talking about the same thing. Look, I mean, to your first question, commodities have a way of viciously mean reverting, right? And so if you're paying a 4-time EBITDA multiple, which would historically would have been that low multiple that you quote shouldn't pay on a cyclical, right? That can go to 10 times EBITDA in a flash. If commodity prices get cut in half, which by the way is almost certainly going to happen in a broad basket of commodities right now, because we've got everything from, aluminum is probably 50% up above its marginal cost of production, to coking coal is 300% above above the marginal cost of production, right? And so these prices are coming down for sure. But look, so you've got that issue where 4 times EBITDA can turn into 10. That's why that was a great thing, a great market maximum. Growth capex has a way of being both destructive to the company and the industry, and so another reason why that's been a great market maximum. M&A has a very spotted track record. You have industries that have had rounds of bankruptcy. So the reason why that market maximum exists is very sound logically. The issue is just that at our current point in time, it just got stretched way, way, way too far. And so if that 4 times is 1.2, that's different, right? And again, I talked about this before. That's like Chiefs Jags last year. If you want to bet on the Chiefs laying 14 points, it's a 50-50 bet. If you want to bet on the Chiefs laying 32 points, you should probably take the Jags, right? I mean, 0.2 times EBITDA versus 4 changes the odds of the trade working by a lot.
I think another thing was, it wasn't just, I agree with you on the multiples, and it wasn't just like the multiples at one point in time. It happened for like 6 to 9 months, right? So at that point, it wasn't like they were trading super cheaply on some hugely levered bet, right? They made so much money and printed so much free cash flow that by the end of it, they had all this cash. US Steel basically paid down all their net debt and they were generating all this cash. So it was much different than, oh, it's 2 times EV to EBITDA, but 75% of the EV is debt. So you're kind of trading a levered equity stub. Like it just went on for so long that it really de-risked the position. And I am laughing because on Bloomberg, somebody just messaged me and said, who is T-Webs? What a brilliant guy. So I'm just laughing.
There's no way there's confirmation bias in that statement. No way.
But let me ask, so Double Dogs has worked great. Some of the coal names have just been screamers. There've been a couple laggards. The steel names have ended up working great. Like a lot of them have worked great. Which ones do you think are the best positioned right now? And I'll include a link to the Double Dogs post in the show notes so people can go read the original. Which ones do you think, if I wanted to jump in on Double Dogs and say it's not too late, where do you think people should be looking?
Don't do that to me. So 2 of the bottom performers of these 12 names, number 12 is Resolute Forest Products, and number 9 is Green First. Although Green First is up 31% and it's number 9, so it's a little. It feels a little embarrassing to say that it's been a laggard, up 31% year to date. But both of those still have a 1-handle EBITDA multiple, and lumber does have some really big structural demand drivers and some really scary structural supply constraints. And so I would argue, look, there's so many different commodities where I get it. It's the scariest thing in the world when the spot price is 100% above the marginal cost of production. It's actually probably 150% for lumber right now. That's scary, right? Because the spot is going lower. That these equities aren't PhDs. They're more like high school students, right? These equities are going down as spot goes down. Let's be honest with ourselves. But you have 1-handle EBITDA multiples. In the case of, let's say, Green First, they did have some net debt post-acquisition, which is going to get rapidly paid down. Then you're going to be talking about kind of a net cash, small cap, in an industry that's rapidly consolidating. So there's probably an M&A bid under the company. Either that or the company should be buying back a ton of stock by the second half of this year. And I would argue, of course, lumber's not going to stay at $1,200, but I mean, what I did a write-up on Green First, and I essentially said, hey, if you believe that there's a 1-year super spike, but that normalized lumber is 500, versus if you believe there's a 1-year super spike, but normalized prices are 600, it kind of changes everything, right? I mean, you go up and to the right in terms of what the equity might do. And, there's been a little bit of cost push, so you might want to, take those numbers a bit higher in terms of, okay, you've got to believe that normalized is 650, let's say, right? But if you revert back to 800, let's say, because of these, there's such a structural supply and demand issue in lumber if U.S. housing remains strong that you're not going back onto the marginal cost of you're not going back onto the marginal cost curve for potentially a couple of years. And when that's happened in coal right now, you have thermal 220 to 250% above its marginal cost curve, and coking coal is almost 300% above. And so could that happen in lumber for a couple of years? 100%. There's we're in that commodity zone right now where you're in this kind of shortage mentality.
I'm just laughing because you said lumber down to 800, right? And I agree with everything you said on the super cycle, on everything. I'm just laughing because I did a lot of work on Green First when they did the rights offering. I participated. I still own a little stock if anybody wants that disclosure. But I remember in their deck, I'm doing this from memory. I'm trying to pull it up as I say, but I remember in their deck, they were like, hey, lumber's high right now, but here's our models with lumber at 650, right? They were kind of running that as like the little bit good bull case. And like right now, lumber, I think it was 13 or 1400 last I checked. And you're saying if it reversed back to 800, which is way above the levels they were talking about. And actually, I can't remember exactly, but I think they closed like end of August and they had a market valuation on the lumber when they closed. And that's when lumber went from like 12 to 8 and now it's back to 13. So they closed on very advantaged timing, but that's interesting. Yeah, I haven't looked at RFP in a while. Are they buying back shares actively?
Yeah, I believe they did a big special dividend last year.
Okay.
I think they're in the market, but I'm pretty sure that the dividend was bigger, but don't quote me on that.
Yeah, I'll have to go look.
They're returning capital, but put it this way, they're returning capital actively. And this used to be a company with, there was like their balance sheet was a little scary, right? There was some pretty big post-retirement obligations, that sort of thing.
Same with the steel companies,
like a lot
right?
of these other companies.
Yep.
Yeah, totally. Like the balance sheets are so clean versus what they used to be, which is why this trade doesn't make any sense, right? I mean, there's 10 reasons we could keep going, but you just keep coming back to, well, that doesn't make sense. That doesn't make sense. Because again, if you had a scary balance sheet right now and, you were looking at a super spike and you were looking at a spot price way above the marginal cost of production, that's really scary, right? Because if you revert back, there's a lot of left tail risk and you could lose a lot of money. I mean, in some of these cases, it's, oh boy, if that left tail risk plays out, I'm still net cash and, EBITDA will go down by a lot. So it's just the cleaning of the balance sheets is another reason why this trade doesn't make a ton of sense.
My only worry here across all these commodities, and this is actually the same worry I had at the beginning of the year, so everyone can take it with a huge grain of salt, but like my worry right now is a year ago, if you and I had pitched a commodity company, we would have just been laughed out, right? Like everybody would have said, hey, let's go buy some SPACs trading 50% above trust value or something. I'm being a little facetious. Nobody wanted commodity companies. But right now, in my conversation with investors, most people are talking commodity companies. And it just feels, I mean, I was in college in 2007, so I can't claim. It just feels to me what I imagine like when people were talking oil super spike. And remember, Buffett right now is buying Oxy, and Buffett back in 2007 bought a lot of ConocoPhillips, and he ended up selling that at a big loss. And it just, like everyone I talk about, it feels like they're saying things can't go wrong. These things are so cheap. It does feel a little different where it feels like everyone's looking at them and, yeah, these things are trading at 1.5 times EBITDA right now. And that is different than 4 times EBITDA. I'm with you. But, it just feels like so many people say you can't lose, and you can lose. The price comes back down to, from 1,300 to 500. And all of a sudden 1.5 times EBITDA is 8 times EBITDA, which isn't that crazy expensive, but these are commodity businesses. The DNA is real. And I'm just worried it feels like everybody's looking in this space right now. I don't know any real bears in the space.
I think everybody's looking. There's this great Twitter follow, Aggressive Value, that I would recommend everybody follow. He's just he's my Zen Buddha. Crazy daily moves, and he made this point a couple of weeks ago that until I forget which stock it was, but there was probably a peace headline, Russia Ukraine, and whatever stock, of course, knee jerk down 10%. And he said, until you stop seeing this kind of action, it's just proof that you've got a lot of Johnny come lately money in these names and no true believers. And I think there was a lot of wisdom in that statement. There's not a lot of true believers in this sector yet. There was, I hope I don't mess up his name, but I think Eric Mandelblatt did an interview with Patrick O'Shaughnessy a couple of weeks ago, and he pulled every single 13F for, I think what he defined as his 30 or 40 top single manager hedge fund peers. And he pulled all the 13Fs at it was probably December 31st, and they had a 20 basis point allocation to energy and materials. And, right now in the S&P, I think they're 5%. I think they peaked at 17, something like that. But isn't that a stat that just tells you, hey, do you think we're getting a little crowded yet? I mean, until you see that cohort of folks hiring, analysts that cover energy and materials, or pulling teams from other funds, that sort of thing, I think I get it where we're a little hot money crowded, but I really don't think we're anywhere near real money crowded.
Well, let me ask you one question. I want you to play psychologist for me for a second, because I think you and I have reasonably similar views of the investing world. I wish my views leaned more towards commodity than resellers at the start of the year, but I do worry investors fight the last world, right? Like 2020, tech stocks go parabolic because it's the best environment ever for them. Nobody can do anything in person. Everything's online. Tech stocks go parabolic. That runs through about mid 2021. And you mentioned invest like the best, right? Every Invest Like the Best episode is a tech founder or a tech investor or something pitching a tech company. Last mid 2021. And then the bottom slowly starts to fall off. And then from November to today, the bottom fell out quick, right? And now everybody wants to be long commodities, and these commodities are trading, they're still very cheap. As you said, I don't know if there's a lot of true believers. There are some. We had Josh Young on the podcast. That's a true believer who's done fantastic in this cycle, right? But, I've been thinking to myself, hey, Andrew, why were you looking at things, even cable, right? Cable, 10 times EBITDA, great compounder, buys back. Why are you looking at those when you could go look at things that are trading at 2 times EBITDA? And it doesn't even have to be commodities, but the really cheap stuff have worked recently. And I'm wondering, hey, are we leaning too far one way or the other by focusing on cheap stuff now? Like, should we be looking at the broken down growthy stuff, right? Like a Peloton that trades at a pretty cheap subscription revenue, or, Pinterest. I don't know where it's trading right now, but in the past year, PayPal and Microsoft both tried to buy them for a lot higher than the current stock price. So like, are we fighting the last war by still looking at low multiple stuff, or should we be looking at beating down growth or something right now?
So can I tell you where it could get really scary on the upside? I feel like most conversations I'm having right now are all about the left tail and nobody's talking about the right tail. So what took those COVID and work from home winners 2 to 3x higher than they should have gone? I would argue that it's this cocktail of passive money, the momentum factor always working, and the momentum factor working on growth for about a decade, right? So if you think about which factors did you want to be long, it was momentum and growth. Then you had this huge wave of passive money accelerating all these themes. But the most important factor that most true believers always want to be long is momentum, right? Forget about the growth as the secondary factor. So all these names that we're discussing now are, I'm sure, screening first decile short-term momentum, but are going to go first decile long-term momentum before long. And of course, every quant defines long-term momentum differently. So I don't see why, this momentum factor plus passive flows going from nothing to something couldn't potentially accelerate this trade in the same way that the work from home winners went further than they should have ever gone. But now we're talking about stocks that started at 1 times EBITDA. Define what is further than they should have gone to 4 times EBITDA. You know what I mean? Again, that's me talking right tail. That's not me talking my base case. But could that happen given everything that we know about, passive flows and factor investing? 100%. It's not the growth factor that everybody is obsessed with over a 50-year time frame. It's the momentum factor.
Yep.
So again, I just throw that out as one right tail scenario that we could look back in a year, and it wouldn't be shocking that I said that, and it wouldn't be shocking if it played out, and it would take these things way higher than you ever expected. I'm sitting here getting white knuckles because I pitched Arch and wrote off Arch, and it's gone from 80 to, it's in the hundreds now, probably 145 or something like that. And so I'm doing my typical value investor thing where I think I'm being a pig and blah, blah, blah. And I'm sitting here questioning myself when, by the way, the fundamentals have crushed Asians since then. Met coal, which I thought was a dream, was at 400, is now spot 650. And I'm sitting here, when should I sell it? When should I sell it? When should I sell it? Oh my God, it's at 2.5 times EBITDA, you know. What if that name goes to 5? And what's that EBITDA is 50% higher than I was expecting because of what just happened with Russia? These are on the table, right? You know, and that's why, look, each commodity subsector is going to have its own nuance, right? I mean, met coal right now just happens to be in a crazy shortage. So maybe that's the one that ends up being a multi-bagger, you know, but who knows, maybe it's lumber as well. But which is why I wanted to create this index in the first place, was just, I want to tell this story. It's going to be different. There's going to be nuances, but I just want to tell the story.
I'm just looking, and look, I know things change and the asset base is different and everything, but like, just to show that there's not a lot of kind of, I mean, I think there's short-term bullishness, but it hasn't ramped yet. Like ExxonMobil, it's trading under $80 per share today. It was trading over $80 per share back in 2018. And oil then was about 60 and oil today is about 100. And I know how future curves work and everything, but I'm just saying, like, these oil's way tighter. Oil prices are way higher right now. I think the share count's lower because I'm pretty sure they bought back stock in the meantime. I don't know. I know they did a lot of funky things, but you know, you look at the long-term charts of these, and I get the commodity price is really high now, but the share prices for a lot of these guys, it's not crazy. Again, it's still, even after big runs, a lot of them are still 1 or 2 times EBITDA. Cool. Well, Tim, this was great. Anything else you want to chat before we wrap this up?
No, I just want to thank you again, because, you know, when I first came on and did your podcast, I was a total unknown, and you made this joke to me, I think offline, but you said, oh, you're going to get obsessed with, you know, you're going to get obsessed with Twitter. You'll get a bunch of follows because of my show and that sort of thing. And the amount of positive, you know, feedback that I've received in terms of people willing to help you think through a stock or a theme or a trend, because I was, you know, because I was on your show or I published something, that sort of thing, has just blown me away in ways that I could have never predicted. So you were exactly right, and you know, you took a chance on interviewing kind of a random on Twitter that had like 200 followers. So I really appreciate it. So
hey, that really warmed my heart. I'm so glad to hear that. And you know what? It's worth it, because I invested in AMPY at $3 per share, and a lot of that was because you were there holding my hand. So Tim, I really appreciate it. Tim Weber, founder of the Double Dog Index. He's back on the show for the second time. I'm hoping we can have him on for a third time for, would it be the Triple Dog Index? I'm going to think of something that has 2 T's in it. But Tim, thanks for coming on, and looking forward to chatting soon.
Thanks a lot, Andrew.